All right, let's talk about one of the most important financial tools you will ever have, your pension. Now, I don't want you to think of this as some scary, complicated product. Let's frame it as a journey, a personal journey that kicks off with your very first paycheck and hopefully ends with the retirement you've always dreamed of. So, let's get started.
So first things first, what is a pension? Really? I mean, we all kind of know it's for retirement, but it's so much more than that. Think of it like a long-term savings bucket, but one with some serious government-backed superpowers designed to be the foundation for your life after work.
You know, for most people in the UK, this whole journey starts automatically. Sometimes you don't even realize it's happened. So let's take a look at that starting line and see exactly how you get off the blocks.
The starting gun for millions of us was this thing called auto-enrollment. It's a game changer. Since 2012, if you're eligible, your employer has to sign you up for a pension. It's a brilliant move, honestly, because it's brought millions of people into saving for the first time by making it the default easy option.
And the process itself? Couldn't be simpler. You start a new job. Behind the scenes, your employer enrolls you. A little piece of your salary gets shaved off and put straight into your pension pot. And, this is the crucial part, your employer has to put money in too. It's basically a pay rise that you're saving for your future self.
So, you're enrolled. Awesome. Now for the exciting part, watching that pot of money grow. And this is where those superpowers I mentioned earlier really come into play. Let's break down how that actually happens.
Now, pensions pretty much come in two main flavors. The first is defined benefit, sometimes called a final salary pension. This is like a promise from your employer to pay you a specific guaranteed income for life. The second type, and this is way more common these days, is defined contribution. You can just think of this as your own personal pot of money.
And let's be clear, if you've been auto-enrolled anytime recently, you almost certainly have one of these defined contribution pots. And what that means is the final amount you end up with depends entirely on how much goes in and how well the investments do over the years. Your future is directly tied to this pot.
So how does this pot of yours actually grow? Well, there are three main engines driving it forward. First, there's your own contribution from your salary. Then you've got the employer contribution. That's the free money. And then there's a third, often forgotten contributor, the government.
And this comes in the form of tax relief. It's basically a government bonus, a reward for saving. For a basic rate taxpayer, it works like this. For every 80 quid you put in from your take-home pay, the government adds the 20 quid of tax you would have paid. So your 80 pounds instantly becomes 100. It's honestly one of the best deals in personal finance.
Okay, so you've spent decades saving, contributing, and watching your pot grow. Now we've arrived at the big day, the moment you can finally start to get your hands on all that money you've worked so hard for.
Right now, under the current rules, the magic number is 55. That's the age you can start accessing your private pension. Now, it's really important to know this is set to rise to 57 in 2028, but for the time being, 55 is the age that unlocks your pot.
And the first big decision you get to make is a fantastic one. You can typically take a quarter, a full 25% of your entire pension pot as a tax-free lump sum. This is a huge, huge perk. You can use it to pay off the mortgage, go on that dream holiday, whatever you want, completely tax-free.
So once you've taken your tax-free cash, you've got a big choice to make with the other 75%. You can buy something called an annuity, which is basically swapping your pot for a guaranteed paycheck for the rest of your life. Or you can use drawdown, which is where you leave the money invested and just draw out cash flexibly whenever you need it.
When it comes down to it, it's a simple trade-off. An annuity gives you certainty, predictability, peace of mind. You know exactly what you'll get, and you know it will never run out. Drawdown, on the other hand, gives you flexibility and the chance for your money to keep growing. But it comes with risk. Your investments could fall, or you could even run out of money.
We've covered the whole journey now, right? From starting your first job to cashing in at the end. But why does all of this matter so much? Let's just zoom out for a second and look at the big picture.
This number might be a bit of a shock. According to the data, the average UK pension pot when someone hits age 65 is just under £146,000. Now, for some of you, that might sound like a lot of money. For others, maybe not nearly enough.
And this quote, well, it really puts that number into perspective. It says that for most people, that pot of money alone won't be enough for even a moderate standard of living, unless they have other savings to fall back on. It just shows how critical this all is.
But hey, let's end this on a positive note. Don't be discouraged by that. Be empowered by it.
Just understanding how all this works is the first, most important step. Your pension, with all its special powers like employer contributions and tax relief, is still one of the most effective tools you have to build the future that you actually want.
So I'll just leave you with this thought. Your future self, the one who wants to travel, relax, and really enjoy life after work, they're depending on the person you are right now. They're counting on you to make smart choices and to pay attention to this journey. The real question is, are you?